You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Will It Be Different This Time? Written on 25th of November 1996. Let's dive into the timeless insights that continue to influence investors today. All right, buckle up because we're diving deep today.
Ooh, sounds intense.
It is. We're tackling market psychology and investor behavior.
Yeah.
You guys challenged us with Howard Marks' Will It Be Different This Time? From back in 1996.
A classic.
It really is. And, it wrestles with that age-old question. Are we in a totally new era, like one where the old rules of economics just don't apply anymore?
Right. Or are we setting ourselves up for another crazy market swing?
Exactly.
Marx really digs into this using the booming 90s market as his backdrop.
And what's wild is how much of what he was saying back then, it really resonates with what's going on in the market today.
For sure.
So he kicks off this memo with a pretty powerful story.
Oh, yeah.
Yeah, it's about this article. It was in the New York Times in 1987.
Yeah.
And they were super confident that the economy was just going to keep growing and growing.
Uh-oh.
Yeah. Uh-oh is right, because right after that article, the market crashed. So it's a real wake-up call, even the experts can get it wrong, especially when they kind of ignore those historical patterns.
Take a warning. Don't get too cocky.
Yeah, exactly. You got to consider all the possibilities.
Absolutely.
And Marx uses that story to set the stage for, examining all the arguments people were making back then. The reasons they thought the economic boom would just keep going.
What were they saying?
Well, they were saying stuff like, oh, there won't be a bust because there wasn't a real boom. Businesses are getting so much more efficient. The economy is all about services now. And globalization, well, that's an unstoppable force.
Sounds familiar.
Doesn't it? It's like they're describing today.
But looking in a mirror, right?
Yeah, are we just using the same justifications now for these crazy market valuations? It's kind of freaky.
It is. And okay, sure, businesses are probably more efficient now. And yes, service industries are growing, but
that doesn't mean things will just keep going up forever.
Yeah, right. There are limits to efficiency. And even service-based economies, they can still take a hit.
Sure.
And globalization, it's complicated. It can be good, it can be bad. It brings opportunities, but also vulnerabilities.
Totally. Marx even points out how even back in the 90s, people were coming up with reasons for those sky-high valuations.
What were they saying?
Oh, the usual suspects.
Yeah.
Like 401k inflows, corporate buybacks. They were even saying that stocks weren't actually overvalued compared to other assets. Sound familiar?
If that's like a broken record, we hear the same stuff today, just maybe with a little different spin.
Right. And Marx, he brings up this quote from John Kenneth Galbraith. It's about how people have extremely short financial memories during those times when everyone's super optimistic.
It's like we just forget all the lessons from the past when things are going good.
Exactly. And that's when we get into trouble.
Yeah.
Marx also points out all these warning signs that were flashing back in 1996.
What were they?
Well, he talks about how people weren't being skeptical enough.
Yeah.
And how there was all this aggressive lending going on and high consumer debt. And the stock market, well, it was really narrow. Just a few stocks were driving all the gains.
That does sound a lot like what we've seen in the recent bull market.
Right. And that's why this memo, it's so relevant today. It's are we paying attention to those same signs now? Are we getting caught up in the excitement and ignoring the potential risks?
Marx would definitely say, hey, think about this stuff, especially when everyone else is super optimistic.
Yeah, for sure. He also talks about this idea of capitulation.
Capitulation.
Yeah, it's when investors basically throw caution to the wind and just pile into the market.
Oh, wow.
And it often happens right before a downturn.
Oh, no.
Yeah, he even gives this example of a foundation.
Yeah.
They switched from a super conservative bond portfolio to 100% equities.
Yikes. That's a big swing.
It is. And it shows how that fear of missing out, it can make people do crazy things.
Both individuals and big institutions.
Totally. Have you seen examples of that kind of behavior lately? Think about those meme stocks or the frenzy around certain cryptos. Even the rush into tech stocks a few years ago.
Yeah, I see what you mean.
It's often a sign that the market's getting a little too hot. It's driven by emotions instead of, sound investing principles.
Right. It's really amazing how these patterns, they kind of repeat through history. It's like Mark is reminding us that these market cycles, they're just inevitable,
Yeah,
driven by like how investors are feeling and acting.
totally. And he's honest about how even he, as experienced as he is, he's still affected by, his own past experiences. He actually talked about how, like, going through that bear market in the 70s probably made him a little more cautious.
Yeah. That's really interesting. Like he's self-aware.
It's refreshing, right?
It is, because knowing how our own like biases and stuff, how they might be, changing how we see things. I mean, that's super important for making good investment decisions.
Sure.
It's like we all have our own baggage, and knowing what's in there, it can help us see the market more clearly.
I like that.
Yeah.
Baggage.
Yeah.
So, okay, if we had to boil it down, what's the big takeaway here? It seems like Marx is saying, hey, don't get caught up in all the hype. Don't make rash decisions based on, like, what the market's doing right this second.
Exactly. It's all about the long game.
Huh.
Those market cycles, they're going to happen. He even like quotes himself in the memo. He says, cyclicality is not at an end, but rather is endemic to all markets, and that every up leg will be followed by a down leg.
Wow, that's a pretty powerful statement.
It is.
So it's not about trying to, like, time the market perfectly or predict when the next crash is going to be.
Right.
It's about, like, having a solid plan that can handle the good times and the bad times.
Yeah, and that's where risk management comes in. It's not about avoiding risk completely. It's about understanding it and managing it in a smart way. Marx, he believes in being fully invested, but also having some protection just in case things go south.
So how can investors actually use these ideas? Like, what can they do with their own portfolios?
Okay, well, first things first, be skeptical, especially when everyone else is like super optimistic. Don't just go with the flow, do your research, and remember, what goes up must come down.
Yeah, that's easier said than done, though, right? When you see everyone around you making money, it's hard not to feel like you're missing out.
Totally. It takes discipline. But that's why having a good plan, an investment strategy that you actually stick to, it's so important. It helps you stay focused on those long-term goals and not get distracted by like all the noise in the market.
So it's about having a plan and sticking to it, even when things get crazy.
Yep. Another key thing is diversification. Don't put all your eggs in one basket, right?
Why?
Spread your investments around different asset classes, sectors, geographic regions. It helps lower your overall risk.
That makes a lot of sense. So you're not relying too much on any one investment.
Exactly.